Not many other banks or lenders offer these programs either. So we specialize in, the specialty stuff. So ground up construction is for our investors out there to basically build houses. So not a fix and flip. This is beyond the fix and flip, right, Jose? This is full vertical construction, in other words. So I'm not sure which examples you have, Jose. So I'll let you go ahead and take over and explain a couple different options that you put together.
Okay, good morning, everybody. Exciting news, Nick. I got bumps when you mentioned the SCR because we at the Mortgage Calculator are perfectly positioned to allow our investors to take full advantage of the economies of scale that we have created over the last 4 years, as that was a big objective in our business plan, was the investor focused loans. We just did not get into DSCR now that agency was tanking. That was part of our business plan from the inception, which is why we have so many options and which is why we have trained our MLO team so well to be amazing consultants, which is why we get so many investors coming to us with portfolio loans looking to refi all of their properties out of a portfolio loan into individual loans, cash them out, and buy more properties to take advantage of the great rental rates out there. So, getting into ground up construction, excuse me, what I wanted to state first of all is that ground up construction, do not confuse that with one time close programs, right? A one time close program is for primary, or if you're doing conventional, second homes, right? We can do one time close conventional, VA, FHA, and USDA, right? But those are all primary, and conventional could be second home. That is not for a spec home, which is an investor building a home to sell for a profit. That is what the ground up construction program is for. In the ground up construction program, you can already own the parcel of land, which would then be considered a refinance because you have the land, you are putting the land as part of your equity into the deal, and then the lender will encumber your land, and then you build a home, and then you sell it, and you pay them off, right? The examples that I have here are would be more for the person that does not have the land and wants to buy the land along with get the rehab costs as much as they can financed, right? So that's the dream, right? You see the piece of land, you buy it, and you build a home. Now, what I will state with this though is that you need to have plans in place already, right? Those plans need to be approved because you don't want to go through a plan approval process that's going to take 6 to 12 months, and in some cases even more, and eat up most of your construction time, because typically these loans are going to be 12, 18, maximum 24 months depending on the experience level of the borrower, because the longer they extend the time out, the greater the risk, right, that it may not be built. So
So it must be vertical ready in these examples.
pretty much, yeah, you got to have those plans approved. You got to already have a builder, a contractor. Now, ground up construction, contrary to one time close, does allow the investor to also be the contractor if they can provide the necessary credentials and experience. So that is a plus right there. Not all the options do, but most of them would allow. They may charge you a little bit more in the rate, but they do in most cases offer that option, which one time close does not. But just to state, you do have to have a contractor already in place with the credentials to be approved. You know, they got to have their liability insurance, they got to have their workman's comp insurance, they have to have their credit lines, they have to have references, track record. There's a number of things that the contractor needs to provide in order for the loan to be approved. So it's not just like, hey, I want to get that piece of land, let me buy it, and then let me get on the mission to put all of these items in place. You know, you do have to do some planning before you applied for the loan, right? You have to
So
know what you're doing.
they consider this the horizontal part needs to be done, right? All the
Yeah.
planning of the plan part, getting the land ready, needs to be ready to go vertical, meaning ready to put
Yeah.
cement on the ground, put nails and boards, and start building up, right?
Yeah, you
So
got to have your entitlements in place. Definitely. You don't want to get that raw land that's not even entitled yet to for utilities or anything like that and then embark on that mission, which could take a while, right? That's why sometimes what people need to do is they would need to buy that type of land with some type of a land loan, bridge loan type option, short-term financing, get their entitlements in place, and then get the ground up construction loan as a refi, right? You refi and get the construction cost, rehab, whatever you want to call it. So I'm going to share with you three examples today. And the main thing that I'm going to be focusing on is experience level of the borrower, right? In this scenario here, we have a $150,000 lot purchase, $275,000 in construction costs, and a nice profit margin here. We have an ARV of $700,000. So this developer is doing a very good job of managing his project. Hopefully, not going to have any cost overruns. There is a 10% contingency reserve that's built into this loan, and also in this case I have an 18-month term, which you do have an interest reserve as well, right? All of that is built into the loan. So this example here, first I'll go into the rate and then I'll go up into those numbers in a minute. Rate we're looking at for our one unit experience developer is 11.82%. This is an interest only payment, but remember, there's no payment because the interest is built into the loan, right? So in this case here, since the borrower only has one unit experience, the initial advance, that's what they're giving you at the moment that you close on the land, right? The initial advance is $56,794, right? And 84 cents. So whatever, roughly $57,000 of the $150,000 of the land purchase, right? So you're coming up with some money there, which I'll show you in a minute. And the loan amount is $331,794. So they're financing 100% of the rehab, which is the important part to note here. But the borrower has to come up with the difference at closing between the $56,000 and the $150,000 cost of the land, plus some other expenses, which I'll show you right here in a minute. Now, this doesn't include all the closing costs, but most of the general ones. But when you're looking at the 10% contingency, that's what they call liquidity check. That's actually the contingency reserve of 335,000. The borrower needs to come in with $146,541 liquidity reserves. Now that's what they have to show as available that they have to do the transaction. But again, at closing of the lot, 56,794, right? And so that's a pretty good deal considering one unit experience. Now, our 5 unit experienced investor. Now, and by the way, this is for a 5 unit. This is not for a single family. So, I'm here getting our investor that wants to totally take advantage of the great rents and everything, and he wants to have a good project. There's a lot of investors out there that are looking for small multifamilies. They're very difficult to find, a lot of demand for them. So this person says, I'm going to build a 5 unit, and he's going to sell that right away. Or they may decide to keep it as their own investment. You do have that option to refinance the construction loan at the end and hold it, which is very popular now. We're seeing a lot of that going on with real estate developers, with the big condo developments that they were previously putting for sale. Now they're keeping them as investment properties because they're renting so well. So in this case here, our 5 unit investor, you see now that the initial advance increases to $68,615.16, right? Our total loan amount increases to $343,615. So we do have good benefit there. The rate also drops from 11.82 to 11.06%. So we do see a benefit there. Now there is a cost in this product, 3.75 total points. That's the total between the lender fees, the broker fees, and all the origination fees on the loan. And then in our last example here, it would be a best case scenario, right? This is the person that, does this all the time. And by the way, when we're talking about unit experience here, we're talking about in the last 3 years, not in their life that they've been doing this, right? This would be somebody that's really turning over a lot of properties. And when we're talking about experience level here, it's very important to note also that this does not mean homes that they have built as a contractor, right? This means properties that they have been the owner of the project from the inception, when the land was purchased, to the construction, to the exit from the project, the sale. They want to see the full cycle. So this person has been involved either as a partner or as the only participant in at least 10 ground up construction projects in the last 3 years. So this person's been very busy. So you see now the initial advance, very high, right? Remember, it's $150,000 lot purchase. They're giving there $90,263.59 at closing. So at closing, they got to come up with the difference as between that and 150,000 as the down payment, closing costs, interest reserves, and you get the deal. Loan amount of 365,263.59. So you do see the benefit when you have more experience. But again, we have options for all experience levels. But in ground up construction, there really is no experience level option because it is so risky. So what we usually advise our investors that are looking to do their first project is to do it as a joint venture with somebody that does have unit experience under their belt, and split the deal 50-50, however you got to do it, but you get the benefit of their experience level. So at that point, you probably would want to find somebody that has at least 5 units under their belt. You join them, and then you get the first one under your belt, and then the next one, if you choose to, you can do on your own and get 100% of the profit.
That was one of the questions we had here, but I think you answered it pretty straightforward there. But how else can they get experience? I guess, Jose, would be the other part of this question. Does fix and flip experience count?
Well,
they don't need ground up necessarily.
Right. Now that varies from conduit to conduit, right? So there are some options out there that if you have heavy rehab experience, like you did, I think it's like $100,000. I can't remember the exact threshold.
Or half. Now. It's 50%. If the budget was over 50% of the total, if the rehab budget was over 50% of the total project, then it's a major. That's the cutoff there.
Yep. Then that would be considered as an unit experience to be counted for ground up construction. They really want to make sure that you can handle all of the rigors that are going to be involved and still be able to successfully exit the project, because a lot of the issues you could have with the cost overruns, mismanagement of the budget, miscalculation of what it was going to cost you to build, not handling your subs properly. a whole number of things that can happen aside from the usual maybe supply side issues causing increases in your materials. I mean, a lot of people are suffering from that, whether they have 20 unit experience or not. But it's a lot of the other things that can happen that would cause you to mismanage a project, and in the end, run out of money, have a 75, 80% finished project that now the lender may have to look at foreclosing on it, and then it's pretty tough to sell a project that is not complete.
Bad for everyone, right? So let's just, I guess I would like to just walk through this real quick. So the advice to our team here would be, if your investor doesn't have any experience, how do you get them to there? So the correct answer to there, Jose, would be they would do a regular flip, not a major, right? They can't get approved as a first time investor. So this would be for someone that wants to do it all under their own belt, as Jose said, right? If you don't want to add somebody else in your deals, you're going to have to start small with a small flip. And then once you have a couple of small flips, you can get approved for a major flip, as Jose explained, with over 50% of the budget. Usually, once you have 3 regular flips, you can get approved for a major flip. So then your next 2 would be majors. Then you would have 3 regulars, 2 majors. Then you would qualify for the programs that Jose just explained on your own, as long as that conduit allows it and your credit allows it and all that kind of great stuff. So that would be how you get the experience from zero to ground up. There's no way to just come in fresh off, this is my first project, I want to build a ground up, unless you bring in someone who knows how to build ground up or has the 3 minors and 2 majors that would probably get you in the door. So that would be the picture that I would paint to you there, Richard, to get your customer from nothing to prepared. But remember, that's going to take probably 3, 4, 5 years, even if you were foot on the gas the whole time, right, Jose?
Absolutely. I always like to say 100% of nothing is nothing, you know. So, I mean, if the person really has a good idea and wants to take advantage of an opportunity, it's not a bad idea to bring in somebody, especially if you have limited experience doing it, that you're going to be learning while earning, and it's only fair to, share the profit with somebody that's going to help accelerate your growth into the business. And then the next one, could be 12 months down the road to 18 months down the road. If you finish this one fast, just finish it faster and you will get a jump start on your business.
Exactly. That's what Jose said. So you have an idea, you either wait 5 years to get there, to do it yourself, to get the 5 experiences that you need, or you partner with somebody to get the experience today. And then, like Jose said, you do it quick. The next one's all you, right? So just, you got to bite the bullet at some point, right? It's either going to take the long, slow 5 years really to get that experience, or you partner with someone that knows what they're doing. And the lenders aren't dumb. They do that for a reason, because it's good for you, right? It's good for, your investor there to have someone with experience.
All right. I think we can go ahead and wrap it up then. Appreciate everybody tuning in. Great info there, Jose. Remember, we do this show 11 a.m. Eastern every weekday, where we go through live rates and then do a different topic for a deep dive.